So welcome to the deep dive. And today, well, we're not really here to talk about investment strategy, are we?
No, not at all. Or economic forecasting, for that matter.
Exactly. Today it feels more like pathology.
That's a great way to put it.
Yeah.
Our mission today, based on these sources, is a forensic investigation.
It really is. We're opening the file on what feels like a crime scene, and the victim, I guess you'd have to say it's market truth.
And the motive is, as always, hidden profit.
Hidden profit.
Yeah, that's absolutely right. The research you sent over, it reads less like financial analysis and more like a detailed indictment.
An indictment of the whole modern market structure.
Exactly. We're going deep into the systemic threat posed by something called dark pools, these private, parallel universes of trading.
And they've fundamentally changed how price is discovered, or maybe how it isn't discovered.
That's the core of it. It's an investigation into how the casino maintains a VIP room that you are never, ever allowed to see.
Okay, so let's just dive right into that. Let's start with the most shocking revelation, the one that serves as our starting point for this whole thing.
Yeah.
We have to confront this core finding immediately. The price you see on your screen, Apple, Amazon, whatever that price is, structurally a lie.
A lie by omission. And that's the critical part.
Right.
It's the foundation of the entire deception. The vast majority of investors, and I mean especially retail investors, they operate under a fundamental assumption.
The assumption that what you see is what you get.
Precisely. That the stock price you're looking at, let's say Apple's at $200 a share, that number represents the true aggregated intersection of all global demand and all global supply for that stock, right at that instant.
We believe it's the perfect reflection of what?
Yeah.
The collective belief of the market.
Collective belief, that is the ideal. But the moment you start digging into the data, into the actual trading volume,
And that belief is it's shattered instantly.
you find the critical structural flaw. That public price, the one on the NASDAQ, the one on the NYSE, it only reflects a portion of the market activity.
A fraction.
A fraction. The public facade is a half-truth. According to all the data, nearly half, and we're talking consistently, between 40 and 50% of all trading volume happens entirely off exchange.
50%. That number is just staggering when you really think about it.
It's immense. This huge volume moves in that parallel universe we're talking about, the dark pools.
And let's be clear, these aren't some, back alley operations we're talking about.
Not at all.
These are private trading venues run by the biggest, most established institutions on Wall Street. Goldman Sachs has one, JP Morgan has one, Credit Suisse.
Historically, yes, they ran a huge one. These are the institutional VIP rooms, and they are processing billions of shares, often in total secrecy, completely shielded from public view until long after the fact.
So the severity of this systemic threat, it really clicks the moment you quantify that volume, doesn't it?
That's it. If 35% of all the transactions are happening in the dark, then the public market, the lit exchanges, is just the front door. It's the showroom floor.
So our investigation today has to uncover exactly how this massive movement of capital and volume can possibly happen without instantly and accurately impacting the public price.
Yes. How do you hide the market's true supply and demand from everyone who is operating outside those VIP rooms?
It just fundamentally changes the game. When you realize this, the feeling is less that you're just unlucky in your trades and more that you're just systemically disadvantaged.
Yes.
The analogy in the source material is so potent. It says if you're trading based only on what you see on the public ticker.
You're playing poker with half a deck.
Exactly. You're making decisions with 50% of the relevant information, while the pros inside the banks, they can see the full deck. You are structurally set up to lose on execution before you even start.
We can try to visualize this with the iceberg metaphor, which is just, it's essential for understanding this whole structure.
Okay, let's lay that out.
So imagine the ocean surface, what you see, the calm, visible surface, that tiny fraction of volatility and price movement on the NYSE, that's just the tip of the iceberg.
That's the public perception of the market.
That's right.
So that tip, it might look stable. It might show, say, Apple stock just moving sideways, very calm, giving you the impression that buyers and sellers are perfectly balanced.
Or that there's simply low activity. But the hidden truth is submerged. It's below the waterline. And that is a massive, jagged, chaotic volume of trades.
The invisible exchange of billions of shares.
Constantly happening within the dark pools. This huge hidden mass is the actual bulk of the market activity. It's the true indicator of supply and demand pressures.
So if the mechanism that determines the public price is only looking at what's happening on that visible tip,
And that visible tip is only half the total mass.
then the price can't possibly be an accurate reflection of reality. It's a statistical illusion.
It is. It's stability that has been purchased at the expense of transparency.
The consequence of that is just, it's devastating for the entire premise of how markets are supposed to work.
It goes right to the core. Price discovery. The fundamental function of a free market, using all the trade data to assign accurate value to assets.
Which is how we allocate capital efficiently across the economy.
Right. That function is severely impaired. You could even argue it's functionally dead. How can a price accurately reflect the balance of supply and demand when the majority of large supply and demand events are intentionally hidden from view?
It's impossible. But this whole forensic approach, it requires us to be fair. We have to understand why this parallel structure was built in the first place.
That's right.
Because, initially the dark pool solution was rooted in a practical, even an understandable problem. It's what our sources call the whale's alibi.
Indeed. We have to give the historical context. Dark pools weren't, born out of some evil, malicious intent. They were created to solve a real structural inefficiency in the public exchanges.
A problem known as market impact. So let's pull that term, market impact, out of the institutional jargon. Let's make it relatable. We need to think like a whale.
A massive institutional investor.
Yeah.
A $50 billion pension fund, let's say, responsible for the retirement of millions of people.
Right. And this manager, this whale, needs to execute a massive order. Let's say they have to liquidate 1 million shares of Ford stock, maybe to rebalance their portfolio.
Okay. If they try to do that on the public NYSE, they face an inevitable paradox.
The moment they hit the sell button on that massive block of shares,
The market instantly panics.
right. Everyone sees this whale trying to sell 1 million shares. That signals this catastrophic supply pressure. So what does everyone else do? They front run that seller.
They dump their own shares first, or they adjust their bids way, way lower.
And the price just crashes.
It crashes.
Yeah.
If the institutional manager starts selling at, say, $15 per share, by the time they're maybe only 20% through their million-share order, the price might have already dropped to $14.
So the institution has moved the market against itself.
And in doing so, they've incurred massive transaction costs. They've lost millions in value simply because of the visible size of their own order.
And that is market impact. That volatility trap where the seller sabotages their own sale.
Precisely.
So the dark pool emerges as the solution, the private room.
The private room solution. The whale, that pension fund manager, doesn't dump the shares publicly. Instead, they quietly contact an investment bank that runs one of these private exchanges. Goldman Sachs, let's say.
And Goldman Sachs then finds another whale on their system to be the counterparty.
Right. Maybe it's a sovereign wealth fund client of JP Morgan. They negotiate. They agree to swap that million shares at a predetermined price.
A price that's usually pegged to whatever the public price is at that moment, the NBBO midpoint.
Exactly. This ensures the institution gets a fair, stable price, often a much better price than they could get if they crashed the market themselves. The transaction happens instantly on the private server.
So the ownership of the million shares moves. The pension fund gets its sale executed efficiently.
And here is the crucial invisible element. The public ticker tape, the thing determining the visible price for you and me, it doesn't show a million shares being traded.
It's completely hidden.
It either delays the reporting of that volume or it chops it up into these tiny, insignificant little pieces, 50 shares here, 100 shares there. And those are only reported much later through something called a trade reporting facility, or TRF.
So the shares move, the institution avoids sabotaging its own profits, and the public price stays stable.
It stays stable, but it's now divorced from the underlying reality of that immense supply pressure. And that mechanism was originally intended to smooth out these large transactions, to allow big capital to flow without disrupting the entire market every single time a big fund needed to rebalance.
I mean, I get the practical benefit for the institution, I really do. But even right here at its origin, you can see the beginning of the systemic conflict.
It's baked in from the start.
The visual from the sources is key here, the balanced scale. If you have a massive institutional sell order, that invisible whale, and it doesn't even register on the public balance scale,
Then the public scale is giving a false reading.
it's suggesting perfect equilibrium when the reality is a huge influx of supply that's just being absorbed off balance sheet, so to speak.
And this leads us directly to the core forensic finding. the crime itself.
The murder of price discovery.
We've established the mechanism works beautifully for the institutions, but now we have to show exactly why the cost of that stability is the death of market transparency and truth for everyone else.
This is really the central philosophical problem of the modern market, isn't it? Stability is purchased at the cost of truth.
That's it. If 1 million shares of Ford were sold, reflecting this massive underlying supply pressure, then fundamental market physics dictates that the price should have dropped.
That price drop is the information. It's the market absorbing the new reality of that supply.
But when you actively hide that supply from the price mechanism, you effectively guarantee that the public price is false. The dark pool stabilizes the price, yes, but it stabilizes it at an artificially inflated level.
Because the market is totally unaware of the massive selling interest that's being handled behind closed doors.
So the big players, they get their pristine execution. They avoid market impact. But everyone else, the retail investor, the smaller mutual fund, even, the global economy using stock prices as a barometer of health, is trading based on a price that is intentionally divorced from reality.
It's a fundamental betrayal of the free market ideal.
We have to emphasize this. This creates a fake price for everyone else. This systemic, intentional hiding of supply and demand means the foundational function of the capital markets
Price discovery
is not just compromised. It is rendered totally ineffective for determining true value. How can we possibly have efficient capital allocation globally if 40 to 50% of the volume that informs that allocation is operating under a perpetual shroud of secrecy?
This is where that broken mirror metaphor really comes into sharp focus. The market is supposed to be this perfect mirror.
Right. Reflecting the true value of the economy, showing where capital should flow, driving productivity.
But when that immense volume is routed into the dark, the mirror is it's cracked. It's reflecting a distorted and often an overly optimistic image.
On the surface, we see smooth sailing, maybe a healthy bull market. But if we look closely at those cracks, the source material suggests we see these signs of instability. Massive underlying selling pressure that the public price just isn't registering.
And this distortion, it provides the aha moment for so many investors who watch baffling market behavior, like, why did my stock trade sideways for 6 months despite terrible news in the sector?
And the answer might be because institutional buyers were quietly accumulating massive volume in the dark pools. They were absorbing all that selling pressure silently, keeping the lit price artificially stable while they loaded up.
Or the other side of that coin, the scenario that absolutely infuriates retail investors.
The good news is bad news event.
Yes. Why did my stock drop 15% just out of nowhere right after genuinely great news was released, a great earnings report or something?
And that drop can often be the moment, the hidden institutional selling pressure. The whales that had been offloading their positions in the dark pools for months finally became too massive to contain.
The dam breaks.
The dam breaks. The remaining volume spills over onto the lit exchanges, and it causes a sudden violent repricing based on the true enormous supply that was previously masked.
So the institutional players, they successfully got out at the top in the dark, and the public market gets the bad news, the crash, when it's already too late.
That's the mechanism.
That transition from, institutional self-protection to explicit retail exploitation is the most cynical part of this whole forensic file.
It really is.
Because the dark pools didn't stay as this, high-minded playground for whales. They evolved. They evolved into a predatory profit engine designed specifically to hunt minnows.
The retail investor. This shift represents the structural betrayal. Initially, dark pools handled exclusively massive block trades, orders of 10,000 shares or more, the kind only institutional giants execute.
Right.
But the banks and the market makers, they eventually realized that trading against a large, sophisticated hedge fund, that's risky. They're smart. A richer, easier, and much more predictable source of profit lay elsewhere.
And that shift came with the adoption of what they call the odd lot strategy.
Yes. For generations, trades under 100 shares were considered trivial. An odd lot, largely ignored by the big players because they were too small to cause market impact, too small to bother with.
But that view changed completely with high-frequency trading and zero-commission brokers.
Fundamentally. Now, algorithms actively hunt for these tiny orders, your purchase of 10 shares, your sale of 50 shares, and they route them directly into dark pools.
And the motivation is just.
Yeah.
It's simple and it's predatory.
It is. They realize that retail investors, who they condescendingly call dumb money, are highly predictable. They're liquidity demanding, and they're generally uninformed about optimal execution timing.
I have to say, hearing that my little 10-share buy order is being routed directly to a bank's private pool just because I use a free app, it feels like a fundamental betrayal of the open market ideal.
Of course.
It reinforces this idea that you're not participating in a truly public exchange. You are trading inside a bank's private casino where the house has meticulously calculated its advantage.
They would much rather trade against you in the dark than against a sharp competitor in the light.
And the mechanical process that enables this exploitation, it's called internalization.
Yes. When you place a buy order through one of these zero-commission brokers, that broker does not send your order immediately to the NYSE or the NASDAQ.
So where does it go?
They sell it. They sell the order flow to a large bank or a market maker, who then handles it internally. They internalize the order.
Which means the market maker becomes the other side of my trade. They become the counterparty.
That's exactly it. If you, the retail investor, want to buy 10 shares of Apple, the market maker, which holds this massive dynamic inventory of Apple shares, sells those 10 shares directly to you from their own supply.
And if I want to sell, they buy them from me.
Right. They stand in the middle of every single transaction.
And they perform this internalization, what, billions of times a day?
Billions. And the profit is generated by accumulating the spread. That minuscule difference between the highest price a buyer is willing to pay, the bid, and the lowest price a seller is willing to accept, the ask.
We all know what the spread is, but let's detail how they capture it so efficiently. It's that tiny little fractional difference, right? A penny or even a fraction of a cent per share.
But when you multiply that across millions and millions of retail trades every single minute, it accumulates into massive, consistent, risk-free profit margin.
Risk-free, that's the key.
Let's use an example. Imagine the public price, the NBBO, is $19.99 on the bid and $20 on the ask. If you, the retail investor, place a market order to buy, you're expecting to pay $20.
Okay.
The market maker executes your order at, say, $19.99.5. They give you a fractional price improvement of half a cent, which they are legally required to do.
So I feel like I got a good deal.
Right. But they then immediately sell that share back into the market at $20 or higher, keeping the other half-cent difference. And they magnify that across millions of shares.
So that half cent per share, which the market maker captures by standing in the middle, that's essentially value that was extracted from my potential savings.
For your profit.
Mm-hmm.
The visual analogy from the sources is perfect. The small fish, the retail investor, thinks it's swimming freely in the open ocean of the public market.
But when you pull back,
It's actually in a small, contained bowl sitting directly on the shark's dinner table.
wow.
And this whole model relies on the predictability and the sheer volume of retail order flow. They know you aren't moving the overall market price. And because they see your orders seconds before the public exchanges do, they can manage their inventory and their risk perfectly.
Which leads us directly to the smoking gun.
The technical mechanism that fuels this entire minnow trap.
This is the critical mechanism every single retail investor has to understand because it defines their actual relationship with the market. Payment for order flow, PFOF.
It all comes back to PFOF.
We have to address the illusion of the free brokerage. If you are not paying a commission, you have to accept that you are the product being monetized.
The cynical question isn't if the broker is being paid, but how much. Why are these major brokers like Robinhood able to offer $0 commission trades?
Because they don't execute the trade.
They don't. They sell the right to execute that trade. The order flow to a powerful market maker, a giant high-frequency trading firm.
And the market maker that's consistently highlighted in the sources as the dominant buyer of this order flow, paying millions of dollars for the privilege,
Is Citadel.
Citadel. So let's make the transaction explicit. I click buy on my phone. My broker, Robinhood, takes that instruction and sells that data, my intent to buy to Citadel.
Yes. Citadel then routes that order into their own internal dark pool, the one often referred to as Citadel Connect. By paying for the retail order flow, they have purchased the ultimate legal informational advantage.
They've seen my cards.
They've seen your cards and the cards of millions of other retail investors before the public market has, and crucially, before they play their own.
This is the essence of what they call legal front-running.
It is. It's not the old illegal version where a broker used insider knowledge. This is systemically engineered front-running, and it's done via speed.
By seeing that retail order flow seconds or even milliseconds before it's executed, the market maker knows which way the market is leaning.
Probabilistically, yes. They know the collective retail class is about to introduce this immense buying pressure on Apple at $200.
And that tiny fraction of time.
That's all their sophisticated HFT algorithms need. They use something called collocation. Their servers are physically located right next to the exchange's servers to minimize latency, the travel time of information.
So when they see the retail order flow coming in from the brokers,
They can instantly adjust their own quotes on the public exchanges. So when your retail order finally hits their internal pool for execution, they are selling you inventory they just acquired fractionally cheaper. Or, buying inventory from you they know they can sell immediately for a higher price.
they adjust their quote instantly across the entire market to reflect the demand they know is coming, but which the market itself hasn't technically registered yet.
They use the retail flow as predictive data. It allows them to hedge their risk to zero and essentially scalp those pennies perfectly every time.
And the crucial part of this whole transaction is the price improvement.
Right. The fig leaf.
The market maker is legally required to give you a price that is technically the national best bid offer, or NBBO, or marginally better. But as we just discussed, they're the ones who capture most of that marginal improvement.
They keep that small fractional savings for themselves instead of passing the full benefit on to you, the investor.
And this mechanism, this is the slaughterhouse, as the sources call it, where value is systemically transferred.
It is. The market maker ensures they're always the counterparty who profits, and they justify it by saying, hey, we gave you a free trade and a tiny price improvement.
But the real cost of that free trade is the monetization of your intent and the loss of billions in accumulated price improvement that is instead channeled directly to the HFT firms.
The forensic verdict on payment for order flow is absolute. The retail investor is definitively the product. Your data, your intent to buy or sell, is the most monetized asset in the entire equation.
This is a transfer of wealth. Billions of dollars moved every year from the collective retail class directly to the high-frequency trading class.
It is an entirely baked-in structural advantage.
Okay, so we've established the crime, the motive, and the weapon. What is the grand implication for the entire system? Beyond the ethics of it, what's the systemic risk of having half the market volume hidden? It just feels like we're not just trading on a shaky foundation. It feels like we are walking on thin ice.
That analogy is perfect because it describes the danger of artificial liquidity. We have a market that is fixed, not broken.
Fixed, not broken. I like that.
It's structurally designed for institutional profit. The danger, however, isn't that the system stops working during normal times. The danger is that the stability provided by the dark pools is purely theoretical.
Meaning?
When institutional confidence wavers, that artificial liquidity evaporates instantly, and that leads to catastrophic instability.
You're describing the genesis of a flash crash.
Exactly. Let's draw that direct mechanistic connection between dark pools and these sudden violent market events like the flash crash of May 2010. Historically, when the entire market was on the lit exchanges, even a large seller had to slow down. Their size impacted the price, which provided a natural brake on volatility.
Right. But now, the massive institutions, the whales, they use dark pools to maintain stability. They absorb huge volumes silently. They're essentially supporting the floor of the market, but in the dark.
They are the hidden shock absorbers.
Exactly.
They're the market shock absorbers.
Yeah.
But what if those same whales suddenly perceive a new massive risk? A global event triggers a cascade of selling.
They stop absorbing.
They stop. They abruptly decide that supporting the price by buying massive amounts of hidden volume is now too risky for their own balance sheets.
So when they step away, that massive hidden volume, the millions of shares they were quietly transacting.
It gets instantly and simultaneously dumped onto the lit exchange, onto the public markets.
And the public market structure, which had been relying on that hidden stability, suddenly has to absorb 40 to 50% more selling supply than it was ever priced to handle.
The artificial liquidity vanishes. And because the HFT algorithms that dominate the public market are built on speed and reaction, they see a sudden vacuum of bids and they immediately pull their own bids. It leads to a sudden, violent crash.
Stocks can drop 10, 20% in minutes?
In minutes. Purely because the expected depth of the market was a statistical illusion maintained in the dark. We're all walking on thin ice, believing the ground beneath us is solid and deep, when in reality it's just a thin crust of public confidence.
So the investigation concludes that, look, shutting down dark pools is probably not going to happen.
Politically and pragmatically, it's improbable. The sheer power of the institutional lobby that created them and now profits from them is Just too strong.
So the strategy has to shift. The goal isn't to ban them anymore, but to learn how to operate intelligently within this fixed system. If we can't eliminate the dark, how do we learn to see in it?
And the sources outline 3 core strategies for the informed investor. Strategies designed to shift you away from being the product and towards being a shrewd strategist.
Yeah.
The first strategy is learning to track the footprints of the elephant.
The footprints being the dark pool prints.
Exactly.
These are those massive, anomalous block trades that eventually hit the public tape, but often hours or even days after the transaction was actually executed off exchange.
They are the delayed evidence of the whales moving. Correct. These block trades, sometimes involving hundreds of thousands, even millions of shares, they signal undeniable institutional intent.
It's definitive evidence that a major whale has recently entered or exited a position.
Right. And while you don't see the trade live, tracking the appearance of these giant footprints provides critical long-term intelligence. If you see a massive accumulation print on the tape, it suggests a large informed entity has confidence in that stock.
So you can ride the wave that entity is creating, not the volatile short-term noise.
It's essentially forensic accounting, but applied to delayed trading volume.
Okay, so strategy 2 involves taking control of your own execution, bypassing the monetization engine entirely.
Direct routing. This is the crucial step for a retail investor to reclaim agency.
So since the fundamental problem is that they sell your order flow to a market maker's dark pool,
The solution is to pay a small commission to send your order directly to a transparent, lit exchange. We have to talk about the alternative exchanges here, especially IEX, the investors exchange.
right, IEX was founded specifically to combat the advantages of HFT and dark pools. What's the technical feature that makes it a viable strategy?
It's the speed bump.
The speed bump.
IEX routes all incoming orders through a 350 microsecond delay coil. It's the literal spool of fiber optic cable that's 38 miles long.
And 350 microseconds is just long enough.
To neutralize the HFT advantage, high-frequency traders rely on seeing the order flow data on one exchange and then racing to exploit that information on a different exchange fractionally before the order arrives.
So if a market maker sees my order hitting the NYSE and tries to race to IEX to front-run me,
The 350 microsecond speed bump ensures they arrive at IEX after your order has already been executed.
it makes their whole strategy unprofitable.
Precisely. It makes the pursuit of that fractional price arbitrage against retail orders unprofitable for the HFT firms on that particular exchange. Advanced brokers now often allow you to select IEX or route directly to the NYSE.
Which guarantees your order will be filled on a lit exchange in the public eye, where you have a better chance of real, transparent price discovery.
Even if you pay a small, explicit commission, $5 or $10 a trade.
And that trade-off is just, it's so stark, and it's personal. Do you pay a small known commission to preserve the integrity of your execution?
And ensure you are not being monetized as the product.
Versus receiving a free trade that costs you potentially much more in those accumulated fractional losses.
And finally, the most powerful and fundamental strategy, the one that defeats the HFT and dark pool model entirely.
Patience. The long game.
The long game. Dark pools and HFT firms are built on exploiting milliseconds, short-term volatility. They make their billions by scalping pennies from the transactional noise of the market. They are optimized for speed.
And if the investor simply changes their time horizon,
The entire system of exploitation collapses. If you focus on acquiring quality assets and holding them for years, 5, 10, 20 years, the HFT firm's millisecond advantage becomes mathematically irrelevant.
they can't exploit a position you're holding indefinitely.
Their whole strategy relies on you being fast, reactive, and transactional. Your ultimate defense is patience, knowledge, and a commitment to long-term ownership.
You can't beat them at their own high-speed game.
So the solution is to change the game entirely. Remove yourself from the short-term transactional volatility that they feed on.
It's really the ultimate market wisdom illuminated by this whole forensic process. Don't play poker with the house when they have 50 cards.
Invest in durable businesses and let time be your multiplier. That's how you render the dark pool's speed advantage totally meaningless.
So this investigation has really laid bare the structure of the modern financial casino. We've established the market is structurally fixed, that price discovery is impaired.
And that retail orders are actively monetized as the core product of the system.
The structural questions that remain now are, they're vital. We've moved past the technical mechanics. Now we have to confront the societal impact.
Yes.
The sources pose a critical final debate, and it's one that has to resonate with every listener. Is it actually fair, philosophically, for big institutions to have a private, protected market, the dark pools, to avoid moving the price?
Or should every single trade, regardless of size, be public instantly to preserve total, unquestionable market transparency?
It's a profound debate. There's no easy answer.
Not at all. On one hand, maintaining stability and avoiding that massive arbitrary volatility caused by large funds rebalancing.
But on the other hand, if the public price is fundamentally untrustworthy, how can capital possibly be allocated efficiently or justly across the global economy? That's a market built on sand.
It is.
And the personal choice for every listener out there operating within this reality is just as profound. Knowing what you know now about payment for order flow,
Yep.
what's the price of integrity to you? Would you pay a $5 or $10 commission per trade if it guaranteed your order went straight to a transparent exchange like IEX and completely bypassed the market maker's dark pool?
That decision reflects a critical choice. Do you prioritize the low cost of execution, accepting that your data and your fractional value are being monetized?
Or do you prioritize fully transparent execution, accepting the small, explicit cost to ensure you get a fair fight?
Our time examining the shadows is complete, but the knowledge we've gained is the essential tool for participation.
The market is fixed. But understanding the precise rules of that fix allows for smarter, safer, and far less exploited participation.
And if we wrap this investigation up with one final provocative thought, it would be this, based on the long game wisdom we uncovered. In a hyperspeed market that's dominated by HFT and dark pools that focus only on milliseconds, the fundamental unchanging truth remains that the future belongs to the owners, the patient investors who understand they're investing in time, not speed, and in doing so, they defeat the system's core advantage.
Until the next deep dive, happy investigating.